Hey everybody, how are ya? It's Thursday, August the 8th, 7:30 p.m. UK time. It's 2:30 here in sunny Orlando, Florida, where the weather is a balmy 92 degrees Fahrenheit, which is 30-something degrees centigrade. I think I should know that by now, but I hope you're all doing really well during this crazy financial week that we are experiencing. I mean, crazy as in absolutely bipolar. We'll talk about that. How could you not talk about that? How can we not talk about our friends in Japan? How can we not talk about that? Can we talk about that? I think we should. Don't forget, next Thursday, we're going to have CEO of Cufflink Narinder here live on the schedule, all being well, hopefully. He is scheduled to be here, so come join 7:30 p.m. live UK time. Bring your questions from Narinder. If you have questions about Cufflink or peer-to-peer lending or whatever it is, maybe you have questions about your love life. Maybe he'll answer those. Just bring them. And if you could do me a favor and hit that thumbs up. YouTube seems to like that. It only takes a second. Thank you. And subscribe too. Tell your friends and your family about the stream. As we try to grow and spread financial knowledge and education and good fuzzy feelings about investing in peer-to-peer lending and everything else involved. So, a quick shout out, of course, to our sponsor, Cufflink, where you can get up to 10.25% gross per annum. Now over £330 million invested since 2016 and zero investor loss to date. Capital is at risk. Please don't invest unless you're prepared to lose money. Please check rates on Cufflink's website as rates do change. You can sign up at the link below or go to join.cufflink.com/financial-thing. Thank you for supporting our sponsor at Cufflink. We appreciate that. Holly appreciates that. As you can tell, she is a very pixelated camera image today. I don't know why, but maybe she did that. She's having a good snooze. Yes, so thanks for being here. Quick hi to everybody in the chat. Colin Perry in the Peak District. Stephen Hale. From a very wet Nottingham. Why is it wet? It's August. Shouldn't be wet. Paul Bagworth. You are in South Wold on holiday. I don't know where that is. Maybe that's in the Cotswolds. Sounds like a good place to be. Alan Stratford. Hello. Hi, Dave Dawson. Hello, George Batchelor from Bridlington. Wet and windy. Hello, Annabelle in hot and steamy España. Tonight, hand pink waving. It says on my screen. I think that's supposed to be a wave. So, all that to you, Annabelle. Thanks for joining. What are we going to talk about this evening? We'll talk about a few different things. Of course, we had our assets capital update. We'll go through that. We'll take a quick look at the news, a couple of bits and pieces in the news. And we're going to talk about prop land. Talk about interest rates. How could we not? I think I glossed over a little bit last week because it happened the day, I think, on Thursday. I wasn't paying as much attention as I could. So, yeah, let's talk about interest rates, what's going on with that. We're going to talk about what happened on Monday, the crazy stock market fallout that was just a mere blip on the radar and how things have bounced back. Take a look at the trading 212 portfolio, of course, and see how that was affected, which it was, of course. And a letter from the mailbag, etc., etc. Let's get right into it. Try to keep it under an hour today. Let's take a quick look at the loan pad. Just a very quick look at what's going on there. Not really much has changed. Here, we've got still £94 million of loan pad loans, average loan to value at 42%. 228 live loans, 5,511 people lending their money out for an average of 17,349 per person. I'm way below that average. Most importantly, estimated time to sell, always important, and estimated time to invest, less than 1 day. We still have 18 lending partners and an interest coverage fund of just a small amount of £42,000. So everything is just as it should be over at our friends over at LoanPad. Also, by the way, we're going to look at the alternative credit investors list of award-winning companies that are on their awards list that are going to be voted for. And is LoanPad on the list this year? Well, let's find out. We'll find out if they are. But everything looking like it's pretty good, steady as she goes over there at LoanPad. Let's get into that alternative credit investor awards shortlist unveiled. It's not a very short list. It's actually a very long list. I mean, they've got so many different award categories here. Everything from Climate Transition Fund Manager of the Year. That's a bit of a controversial word these days, transition. You know, bit of a joke there. We have Distressed Debt Manager of the Year, Fund Manager of the Year, Fund of the Year, $1 billion plus, and then $1 billion and lower. Impact Fund Manager of the Year, just tons and tons. So we'll get tons of the ones you probably care about. Innovative Fund, less than $1 billion. We see our friends over at Axia Funder on that list, along with M&G, which is huge, and L&G, it's much bigger companies. And then as we scroll down, we've got Mezzanine Lender of the Year. One of the one of the companies on that list is Shojin, our friends over at Shojin. So what do they call it? Nominees? Yeah, one of the nominees. We have Performance sub $1 billion. Blend Network being one of the nominees. So good job to Jan over at Blend Network. And then we get into some names that you've probably heard of. UK small cap categories, IFISA Provider of the Year, Easy Money, Cufflink, Folk to Folk, and Simple Crowdfunding. Which one would you pick if you had to pick one of those four as IFISA Provider of the Year? I don't know. I don't have any ISAs. I'm not allowed to have them because technically, I'm between countries. Then we got Peer-to-Peer Lender of the Year, one of the big ones that we're interested in. Folk to Folk, Crowd Property, Cufflink, and the Money Platform. No LoanPad. No LoanPad. I'm sad that LoanPad's not on this list. I think they should be. Even though these are good nominees. But I'm sure it's hard to pick out of four. Narrow things down to four, because there are quite a lot of good peer-to-peer lenders now out there. But no LoanPad. UK Bridging Lender of the Year, sub £1 billion. We got Cufflink, Somo, Shojin, Easy Money. UK Property Development. Which one would you pick, by the way, if you were picking Peer-to-Peer Lender of the Year out of these four? So you can only pick from these four: Folk to Folk, Crowd Property, Cufflink, or the Money Platform. That's a tough one for me. Well, I probably have to not vote for the Money Platform or Folk to Folk just because I don't invest through them, so I don't know as much, even though we've had Roy from Folk to Folk on the stream. So that would be a tough pick between Crowd Property and Cufflink. They're both very similar companies, and I'm not sure what exactly constitutes as the Lender of the Year. What is it based on? Is it based on returns? Is it based on lender satisfaction, borrower satisfaction? I don't know. So yeah, it would be a tough one to pick. I think I'd have to give it slight edge to Cufflink in my book, not because they're just a sponsor of the stream, just that's what I would personally vote for. UK Bridging Lender of the Year, sub £1 billion. Cufflink, Somo, Shojin, Easy Money, seeing the same people, same companies. UK Property Development Lender of the Year, sub £1 billion. We got Crowd Property, Blend, Relendex, and Capital Rise. And then UK Small Medium Enterprise Finance Provider of the Year, sub £1 billion. Folk to Folk, Thin Cats, and Rebuilding Society. I'm surprised to see Rebuilding Society on there, to be honest. But then again, there are not that many peer-to-peer lending companies that are actually doing SME finance now. I know Assets Capital still is, but hence why you only have three companies on there, because most companies are not doing that anymore. And if they are, it's a very small part of their business. I'd have to give the nod, of course, there to Folk to Folk. Part of ThinkCat's business went bankrupt. And the Rebuilding Society, I've been trying to get the CEO on the stream for months and months, and not been able to do that yet. So I got to give my nod to Roy and the folks over at Folk to Folk for that one. So look at all these even more categories here, and they just go on and on. Law firm, transactions, placement agent, ratings provider. They're handing out an award to the top ratings provider, S&P, Moody's, Fitch, and KBRA. Big names there. S&P's huge. And then here's the judges. You got Christian Fayes from Chief Executive of Fayes and Company, of course, the co-founder of LendInvest. Claire Madden, Managing Partner of Connection Capital. Ayman Mahmood, Managing Partner at McDermott, Will and Emery, sounds like a lawyer. Neil Faulkner, of course, from peer-to-peer ratings and research firm Fourth Way. Mike Carter, Senior Policy Advisor at Innovative Finance, and the Alternative Credit Investors editorial team. I wouldn't want to vote on these awards because I don't know enough about all these different companies to unbiasedly vote. How am I going to vote on law firms and impact fund managers? So I don't envy these people having to vote on all these different categories. It's a lot. I would vote on the peer-to-peer section. Maybe that's what they do. Maybe they let certain people vote on certain things, which is probably smart. Because I wouldn't imagine that the managing partner of McDermott, Will and Emery knows anything about these finance companies. Just take a guess. But so maybe he's the one that gets to vote just on the law firm. I don't know how that works. But that's the Alternative Credit Awards shortlist unveiled. So that usually gets voted, and I think they get awards in December at the banquet, as I remember correctly. Pretty cool. Speaking of Shojin, they have partnered with Alta to expand their investor base in Asia. Alta is a digital securities exchange. I'm not quite sure where they're based. Maybe Singapore. But it's going to allow people in that part of the world to be able to access Shojin's investor products, which may or may not be a good thing, because if they have more people getting into the Shojin loans, it's probably going to make them more difficult to acquire for you. But something to note. Also, I wanted to talk a little bit about Assets Capital, because we got an update recently. We'll go through that update, just highlight some of the important things on there. But inside the update, it says, please log into your account, in your cash account, and make your withdrawal, because they don't want money just sitting in there, which is really important to you. If there's money sitting in there, you need to take it out for obvious reasons. If anything happens to Assets Capital, get your money out. Do I know if anything's going to happen? I don't know. I do know that their loan book doesn't look very healthy, so it's always a red flag, right? When a lot of loans are having trouble. It's obviously the biggest red flag. If you have somebody behind the scenes that creates issues as far as one of the owners, whatnot, that's another red flag. That, as far as I know, isn't happening, but you can look at the loan book and say, yeah, there's definitely some red flags going on there. So we'll take a look at that. But I got to the website, and I wanted to log in and look at my dashboard to see if there was any money in there to withdraw. And I get to the website, and I cannot for the life of me find a login page or a link. Maybe somebody else found it. I didn't find it. It wasn't here. I used to have a little investment button here, or for investors that you could log in. So for anybody that's also looking for it, I did find it by Googling it, but it's investors.assetscapital.co.uk/login. But it isn't freely made available on their website anymore, so a little bit frustrating, but you can go to Google and type in Assets Capital Login, and this link will come up to this page. But yeah, make sure you go in and withdraw your money. If you have anything in cash, just take it out. Importante. So let's get to the update. This was the quarterly update that was sent out. It was sent out. I think it was sent out in July or early August. Let's just run through it. Some important things. The Access Cash distributions are now up to 38 million pounds, and 5 million was distributed during the quarter up to the July 1st date of 2024. If you log in, you'll probably see you have some money in there. I had a little bit of cash in there, so go check that out. Also, reminder to take your money out of cash accounts if they're in there. Now they have introduced an IFISA transfer out fee. It says that they used to average about 60 ISA transfers a month for the 3-month period, and average of 170 per month over the 3-month period after the retail platform announcement was closed and the platform closed to retail investors. So now they're saying that they have continued to monitor the situation, and now they are getting about 400 a month of ISA transfers out, quite expectedly. Surprising to me that they didn't expect this was going to happen. I mean, who's going to leave an ISA transfer or an ISA sitting in the account that's not getting any money and not making any money? Of course, people are going to take it out. So now they're saying they're unfortunately going to have to introduce an ISA transfer out fee so that the costs of the work involved can be substantially financed. Another fee for Assets Capital. That they seem to like passing their fees on to their ex-customers. So now if you want to transfer your ISA out, it's going to cost you £35 per ISA transfer out. It also shows here, to make sure you understand before you get too mad about it, that in their terms and conditions there is a line in there that said they can charge ISA transfer fees if they need to. So they got themselves covered on that angle. What it's saying now is you can use the flexible features of your ISA, your Assets Capital ISA, to keep your fees to a minimum. Because it's a flexible ISA inside of Assets Capital, which means you can take your money out during a tax year and put it back before the end of the tax year. So what it's saying and making a suggestion here is that you take the cash out, put it somewhere else, make some money, get some interest on it, maybe do a cash ISA, and put the money back in before the end of the tax year to help you cover some of those fees, or the £35 fee. Thanks for the tip, Assets Capital. They talk about lender fees in here, and that they have had a significant drop in their income. Overheads became larger. They've reduced the team size to reflect the smaller operational size, and they had a plan which outlined their previous fees, which were 6.25% per annum of performing loans from June to September of 2023, and then from there, October 23 to December 24, 0.9% of performing loans, and post-December 2024, no fees are expected. This equates to an average level fee of 3.52% for the first 12 months, and now a much lower 5-year average fee of 0.88%. It doesn't feel good as an investor when you look in your dashboard and you're making a couple of percent, that they're going to charge more fees on the loan book, but it is what it is. We talk about the loan portfolio update. This what I saw that was very concerning. It says that 27 loans have been repaid over the last quarter for $9.5 million. And if we look down, this is what I thought was a little concerning here with these. Sorry for my butchered highlighting, but had to do it by hand. There is a total number of 109 loans that are performing normally. So if we look at the total number of loans, 208. Look at that. Only 109 are performing normally. 22 are being monitored. That means there's a possibility of trouble. 4 are monitored with a credit event. And then 73 loans in default. Get your head around that. 73 loans. Which is about 41 million pounds of loans out of their 128 million pound loan book. So it's that 50%, a little less than 50%, 43% of their loans are now in default of the total loan book amount. So this is why I say, definitely red flags. So take your money out. I don't know if there's anything going on in the background that's going to cause issues aside of what I can see on these numbers. But yeah, that many numbers where the loans are not doing well is not good. I have not been through every single loan to look at all the notes. It's way too time consuming. I don't have the will to do it. So just purely looking at this, it's not looking very good. 73 loans that are marked as default include loans that are marked as default but not in an insolvency. Some or all loan capital is expected to be recovered. Who knows if that's true. Some of them they're selling property to try to recover that money. You've got personal guarantees being pursued. I think those are usually a waste of time, so not much can come of those. Some capital gets recovered from that, but I would imagine very little. And then you got 37 of those loans that are listed as irrecoverable. So they've been trying to get them recovered over the last 10 years or so, and nothing has happened, so no money is going to be recovered from that point. So I would say, not a great update. You don't want to see this number of loans that are default at this point, but I expect that number actually to get worse as time goes on, unfortunately. So that is Assets Capital in a nutshell. I wish I had better news for you. I really do. But alas, no. I logged into Crowd Property. I wanted to see how they were doing with their loan situation, with what's going on with them. Because, some of their loans, they were having also quite a high amount of loan defaults, or loans that were appearing like they might have been under monitoring. I don't have a ton of money in Crowd Property, so what I did think was interesting when I went to the dashboard was, if you look at the loan status on, see, I have about 100, maybe not that many. If I look at the status of these loans, I see a lot of lives. I see a lot of repaid. But I don't see anything on here which denotes the loan is having trouble, which I think it used to do that. I think I used to be under the status would say default, maybe, if my memory serves me correctly, but that is gone. So I went to one of these live loans, Ash Close. It just says live on it. Doesn't say that the loan is in any sort of trouble yet. This loan was from 2021, and if you go into the updates, it kind of shows that this loan is, I believe, went into receivership, had some issues. You can see right here the update from 2023 in January. We can confirm the receivers being onboarded at the moment. Kind of disappointing that this loan status shows no information about this loan being in trouble. So I wonder, is that a way to cover up what's going on with their portfolio to make it look like things are better than what it is? I don't know. The fact I have to deep dive into each individual loan that I have just to see what the project update is, and that's kind of frustrating. I don't have enough in each one of these loans to worry too much about it because I'm on the auto lend. But I can imagine if you were a select investor who was picking out your own loans, you would want to have a clear understanding of which loans were performing and which ones might be in trouble. And I'm not sure that Crowd Property is doing that in a very transparent way. So a little disappointed to see that. In other news, I know Plend is not a peer-to-peer lender anymore, but Rob's somebody we've had on the stream a few times, as they were originally supposed to be a peer-to-peer lending company, but that didn't come to fruition. But Rob has decided, I got an email, to step down from his role at Plend. It doesn't say what he is going to be doing. I haven't reached out to him because I just got this. I'm going to find out what he's up to. But Jamie, who also we had on the stream, has stepped in as the CEO, so a little bit of a change over there. We had a prop lend update also. Let's take a look at it very quickly. It's still got 74 active loans, 74 commercial mortgages, and 0 bridge and VAT bridge loans. Looks like that hasn't really been a hit for them. There's probably just not much demand, or maybe they haven't gotten too many loan applications for bridge and VAT bridging loans. But only one loan is past term. So they say it's been, the first half of the year has been the busiest for a while for loan repayments. We know it's been frustrating for some of you, but we should acknowledge and celebrate loans being repaid. Why would that be frustrating? Probably because getting a lot of loans repaid, but maybe not a lot of new loans being written. So people have their money sat in their account, not being able to invest it. I think this is a great saying that they have here. Remember the old saying, any fool can lend money, but the skill is ensuring that you get it back. So always keep that in mind if you get frustrated about when you're lending money in these peer-to-peer companies and it's sat in your cash account, you can't lend it out because there isn't enough loans. Number one, you can always move it. But number two, just be glad that you actually got your money back and loans have been performing well, because that really is a blessing. Let's talk about interest rates. Here we go. Bank of England last week made a rate cut. And I'd been talking about this for a while. I thought there would be rate cuts, but I thought they would be very small. And that's exactly what happened. Last week we had a rate cut from 5.25% to 5%. Right? Still the highest since 2008 financial crisis. Inflation has, they say, cooled. I don't necessarily believe that. But following on from that, started to get bank interest rate cuts. So we've had a pretty gravy time with interest rates on savings accounts, but now we see total interest rates being cut 4%. This is Saga, so Marcus Bank, same thing. They're going to be cutting them all the way down to 3.79% on easy access. So here is also, you can see here, this is Marcus Bank. This is going to happen to every single savings account that you are in possession with, I would imagine. Rates definitely going to get cut in line with the Bank of England interest rates. These banks like to loan your money out for more than they pay you. So while they're paying you 3.79, they're loaning it out at 6 or 7. We can look at interest rates here. The European Central Bank kept their rates at hold. You can see in the blue line here, U.S. Fed rates at 5.5%. Bank of England now, this should say 5%. This chart shows 5.25. And we have the ECB base rate still holding, I think, about 4%, 4.25. So interest rates are going up and going down. It creates a bit of a conundrum about what to do with money, right? As these interest rates start to fall, we're back in this situation again where we have to take risks to get yield. Back when interest rates were low during the pre-high superinflation rates, where inflation in the UK went up to 11%, rates were very, very low. The Bank of England was, I don't know, 0.5%, ridiculous. And you just couldn't get any good money on savings rates. You were getting a point, a point and a half. And then we're heading towards that direction again. So peer-to-peer lending then becomes quite an attractive proposition. You have lenders like currently LoanPad that pays 6.5% on a 60-day access. You got Easy Money. You got companies like Cufflink offering a 10.25% one-year rate. I don't see these rates holding. I think the peer-to-peer lending rates are also going to come down in line with the Bank of England rates. So it's not a bad time to lock in those higher interest rates because they are not going to be here forever, and you need to kind of look ahead, forward think. But it creates consumers in a place of having to take on more risk to get yield that they've been used to. People have been used to getting 5% in their savings accounts. And I always said this, that I thought when interest rates were cut, more money would be plowed into places like peer-to-peer lending companies, also the stock market, which should push the money flow and the liquidity up into the markets and should propel the stock markets higher. So start planning ahead because these rates are going to continue to drop. You're going to have to move your money. Well, some people are not. Some people are happy to have a lower risk and leave their money in savings for 3%, 3.5%. There are also other people that have been used to getting these higher interest rates who are not going to be satisfied with 3%, 3.5% anymore. But that time is coming. It's probably, I would say by the end of the year, probably going to see another rate cut, maybe down to 4.75. The Bank of England, maybe 4.5. I don't know. Depends on what happens with inflation. But this is what we predict the UK interest rates are going to be. Right, 5% all the way down to 3.98%. I think this is actually a little bit high. I think it's going to be lower than that. You just plan ahead. So what happened on Monday? We had a really, I would say, shocking little stock market blip that led to mass panic. Our friends over in Japan, who I'm a big fan of Japanese. I mean, they got some good stuff. They got great cars. This is going to sound very stereotypical. They have a great culture. They got great cherry blossom trees and good sushi. I mean, without Japan. But I did hear that sushi was actually invented in China. I don't know if that's true. But our Japanese friends decided to panic on Monday and cause global panic with their stock market, as I think it dropped 12% in one day, which is huge. I mean, it's not a crash. I don't think that would be considered a crash. I mean, a crash to me is 30%. But there's definitely a correction, which sent shockwaves through the different global stock markets, and people really panicked. It happened in the US, it happened in the UK. It's funny how these things kind of mirror each other. And everybody thought the sky was falling, and that was the end of it. The markets were going to go, bottom was going to fall out. Bitcoin was panicking, Bitcoin investors. But there's been a lot of reasoning as to why this happened. At the end of the day, when stock markets go down, it's always due to sentiment. It's the people who are buying and selling shares that control the stock market, whether that's institutions or retail investors. But if they panic and their sentiment goes negative, they sell. And that's how people panic sell and sell when they shouldn't be selling. They should be buying, but people always get that mixed up. I was actually one that was buying on October the 5th. Sorry, not October, August 5th, on Monday, when things were dropping. I saw that as a great opportunity, so I went in for better, for worse, and bought more. But a lot of people were selling. They say that was the worst crash in the Japanese market. Again, it's not a crash. It was a correction. Worst correction since 1987. Right? A lot of people were saying, well, why did this happen? There was some theories about leveraging. A lot of people had leveraged the currency, taken loans out against their currency, against their stocks, and they had purchased other currencies to hedge and make money, and those currencies fluctuated and turned the wrong way on them, and they got liquidated, and the markets absolutely tanked because of that. There was a surge in the yen. The yen hit a 7-month high against the US dollar, so the yen got really strong. What you need to understand is when a currency gets strong, it's actually not good for the currency. The stock market tends to take a beating when that happens in some cases, which I think is what happened in Japan. But then the next day, funnily enough, what happened? Everybody panicked, and the next day, so if we have a chart, there's a chart here. Hopefully you can see that okay. The orange is the Nikkei 225. This is a 5-day chart. Right here, let's look at the 1 month. This is a 1 month. You see this crash happened on Monday. It was already starting to drop over the weekend. The futures were dropping, and then you saw this big drop off. But what happened? Over the next couple of days, starts to recover. Still hasn't recovered all the way, right? But it did recover, as did the U.S. markets. Not all the way, but they bounced back. Some people call that a dead cat bounce, where you drop the cat, hits the ground, bounces back up, and then falls again. But we haven't really seen this fallout. It's been pretty steady today. Things seem to have settled down. I don't think the global leaders of the world can afford for a market to stay bad too long. So what happens when the stock market looks like it's struggling is liquidity piles in, whether that's, again, in the form of government money, retail investors, institutional investors buying, and again, the markets, they go up. So it was a very interesting time, and a time for some really great opportunities. Bitcoin was on sale. It went down to about 49,000. Some of the stocks that you know and love, like including our amazing Vanguard U.S. index tracker and global trackers, were both on sale at really good prices. And if you had the heart and the courage to buy when everybody else was selling, you made some money. Not everybody can do that. Some people stay put, which is the right thing to do. This is not the time, I believe, where we are heading for a market crash. In fact, I think we're going to have a big rally. I think there's going to be a big rally, even today. Today you saw, right? If we look at the 1-day chart, we've had a good day today. Started down here, S&P 500, 52, 54. We're now at 53, 13. I think some of the index trackers were up about like 2.5% in 1 day, which is crazy. That's super volatility. S&P today up 2.2%. So I think we're going to see a big rally. You can see here, this is at the start of the day. We had a bit of a dip, and then boom, rallying up. More liquidity going into the market. Crazy, crazy times. We saw the Bank of Japan also raise its interest rates, which is kind of goes against what everybody else is doing, even though their rates are just so low anyways. They raised its key short-term interest rate to around 0.25%, which is super, super low. Their rates are just too low to begin with. That's probably another reason why we had that scare. But yeah, it was an interesting day for the markets. The poor trading 212 portfolio really hit hard. One of our biggest holdings, Nvidia, if we look back on the 5th, right here you can see it was down to $92. So it had gone from 107 all the way down to 92. Great buying opportunity If we look at that from the month, I mean, we've gone from 135. There's a 35% discount you could get off that. We have an earnings report coming in August, which I believe is going to be very good. But all of the stocks got hit that day, and the portfolio actually dipped below 19,300, I believe. But even Coinbase shares dropped. Everything went bad. I mean, look at Coinbase. Coinbase has gone from 266 down to 194. I actually bought some more. So I saw it as an opportunity to go in there and then pick up some shares. We still, Valco Energy, I mean, look at this. We've lost 11% on Valco. And then you'll see a new addition to the portfolio. Look at this, the trusty Vanguard S&P 500 ETF, the accumulation ETF, which is, tomorrow will show a better number than this because it's always a day behind. But yeah, we put a position into there just because I don't know what to do with the money at the moment. I don't feel like adding much more to these positions. So I thought this is not a bad spot for a bit of stability. And so we've added there. And the portfolio currently sits at £20,803 right now. Really desperately, we tried to get over that £22,000 mark, but haven't gotten back there yet. But I think we're going to have a big rally coming up. I think it's going to take a couple of weeks for the Japan thing to settle down and people's nerves to settle down. But I think within the next month, we're going to see a rally. A lot of liquidity out there that is going to go into these markets. For everybody that panicked, because I know people panic. I panicked when I looked at what the stock market was doing on Monday. I thought, oh God, this is it, right? Even though it didn't make any sense as to why Japan would affect everything so badly. Now I read this tweet, which I think is very poignant. It says in 1929, the stock market crashed 90%. In 73, it crashed 50%. In 87, it crashed 35%. In 2008, it crashed 55%. 2020, it crashed 35%. But it recovered to a new all-time high each time. Don't let short-term fear control your long-term decisions. Zoom out. I think that's really, really great advice. Vanguard has a great article about how to navigate market turbulence. They do this because they want people to keep putting money into the Vanguard products. But there's very good advice in here. Number one, bear markets are part of life. Keep a long-term focus. This is a chart that shows you here the bear markets of the different periods through 2007. It just shows you how the market's done through those bear markets. So usually after you have a bear market or a severe sharp drop, it's followed by a rise up. So each time you can see it. Historically, drop, rise up, drop, rise up, drop. Right here in 2020, rise up. Timing the markets is futile. The best and worst trading days happen close together. Look at that. It's a great example this week. Monday, terrible day. Right? Tuesday, good day. Today, amazing day on the markets. 13 out of the 20 best trading days occurred in the years with negative returns. 9 of the 20 worst trading days occurred in years with positive returns. Got to play the odds. Don't panic during market turmoil. The chance of underperforming if you switch investments to cash. If you switch and you do what I've been doing on the trading 212 portfolio, you're probably going to lose. Right? It says here if you went 12 months in cash, you were 79% probability of underperforming a 60% equity and a 40% bond portfolio with an average underperformance of 9.1%. So taking your money into cash will negatively be a detriment to you, so don't do it. Stay invested. Because you'll never know when those bottoms and tops are anyways. What you can do when volatility hits, tune out the noise. That's something that I do. If I don't have any cash that's available to invest when markets are going crappy, I just don't log in. I don't look at it because it makes me feel shitty. I don't like feeling bad. When I log in and see red numbers, it makes me feel bad. So I don't do it. I tune out the noise. Control what you can. Costs. Low cost index trackers. Hint, hint. Set realistic expectations. Historical return averages simply that. Averages. So when you have a bad day, you're going to have good days. Averages out. Stay diversified. One way to insulate your portfolio is to blend shares and bonds. Not a big bond fan, but when interest rates do go down, bonds probably will be a better choice. But right now, not so much. But you can do other things like have. There are some products out there that will give you secure rates, fixed income on your portfolio. Money market accounts, things like that. For example, Trading 212 offers a 5%, 5.25% product on cash. So that's how you can create a balanced portfolio. It's a good article by Vanguard. Enjoyed it. Speaking of our U.S. index tracker, U.S. equity index tracker, Vanguard, look, it's on sale right now. For anybody that's saying it's been too expensive, 52-week high of £968. You can buy it now. It's probably going to be closer to maybe 907 tomorrow. But you can pick it up for about £60 less. So what is that? 4%? 5%? 6%? 6%. You get it for a 6% discount. Not a bad time. What time is it? 3:15. Let's take a quick email. This one came through. This was in April. Hi, Lawrence. I wonder if you can offer me some advice. A year ago, I purchased a new car using PCP to finance. Oh, dear. I had to look that up, actually. I didn't really know what it was. But it's I think it's basically leasing. So you put the down payment down. You make payments on your car and your new car, and then at the end you give it back or you can buy it out. So says on the email, this is Patrick in Maidenhead, I found myself struggling to keep up with the payment. As I understand, I'll have a balloon payment at the end of the 3 years. I don't think so. I think you might be mistaken about that. That's if you wanted to buy the car. You would, but you could just give it back. I'm trying to plan ahead and dig myself out of this mess, which is costing me £299 per month. I'm having major buyer's remorse. For those couple of months, I love the car, but now it has some scratches on it, and it was bashed when I parked it outside my flat. That's terrible. I don't feel the same satisfaction for the car, not to mention the financial bind the car has put me in. Do you have any advice how to get out of this situation? Thank you so much. Patrick in Maidenhead. Cars have become expensive. Nooses around a lot of people's necks. Says now the average new car price in the UK is £40,000, which is too high for most people. 40 grand, imagine. Imagine when new cars were so much cheaper. Going back to the question, there's a couple of things you can do. You're probably underwater in the car. It's probably not worth what you paid for it from a year ago, but there's a company called Kazoo. You can find out what they'll give you for the car. See if it matches closely to being able to give it back and just pay off whatever you owe on that lease or on this PC. What's it called? PC? It's not PCP. Yeah, it is PCP. Also another drug. Not good name, but yeah, go see what it's worth, Patrick. And I always think it's good to get out of these situations if you can. Sometimes you might have to take out a loan from your bank, something as long as the interest rate is reasonable. Or if you have cash and you can put some money to paying it off and getting rid of it, you could do that. It's a bit of a tricky situation. A lot of people get in these PCP and lease situations and then have exactly that. After a year, the car doesn't smell quite so new. They don't get the same enjoyment. They just keep getting that payment bill in the mail every month for hundreds of pounds, and it becomes a bit of a sour thing. So it's not always a good idea to get into them. Sometimes there's great deals on PCP, but I found for the majority that they're not good deals, so best to kind of avoid them. I always say if you can't afford to buy something in cash, you cannot afford it. Most people can't afford to buy new cars cash. especially younger people. So they should really buy cars that they can afford and they can pay cash for and never put themselves in a situation like this. But since you are in that situation, I say go to the dealership, talk to them, see what it is you owe, see what it's going to take to pay it off, or get out from underneath it. Sounds like you don't want to be in anymore. That's the best advice I can give you. Maybe you have to go to some family members and borrow some money from them, pay them some interest to pay it off and get out of it. Sounds like you were never in a position to afford a car like that to begin with. Unfortunately, a lot of car places, they use predatory tactics to get people into vehicles that they really cannot afford to be in. And then it ends up in situations like Patrick's, which is really sad. But I hope you can get yourself out of it. Thanks for sending that question in. It's a good one. Let's see. Insanely draconian. The European Union is thinking of having constituents register all of their assets, including bank accounts, cryptocurrency, real estate, precious metals, cars, watches, and art. What is happening in the EU right now? It says it's an aim to increase transparency and better combat money laundering. Blah, blah, blah. Please. This is an aim to keep control of everything you have and to introduce a central digital currency so they can track all the money, because they don't want anything hidden. Let's look at the Bitcoin price very quickly. 59,774. You could have bought yourself some Bitcoin at 49K and been 10,000 up if only you'd have had that insight, right? Buying opportunities. Look at that rebound. Everybody said Bitcoin was done at that point. Bitcoin's resilience bounces, boom, boom, and then back up again. There was a report from VanEck, which is the big money manager. They put out a Bitcoin 2050 valuation scenario. It's a long report. I'm not going to go through it. I'll put myself to sleep. But you can Google it. Google VanEck. I'll put the link in the description after the stream if you want to read it. It takes about 10 minutes. All you care about probably is the valuation. And some of their reasoning is the interest expense of the four major governments are going to surge. This is a great point. So all the governments that are in debt right now have borrowed all of this money, the U.S. being one of the worst borrowers of them all, 33 trillion US dollars or something crazy like that. They're going to have to pay for the interest on those loans and on that debt. It's saying here, you can look at Japan. That's bad. Government interest expense is going to be over 10% of gross domestic product. And we got the EU down here, 5%. The US at a little bit under 8%, and then the UK a little bit over 6%. They're going to have to service that debt, which means more money printing is going to happen because they can't pay off the debts because they've put themselves in such a big financial hole. That means the money is going to get debased, the currency, and that's the case for Bitcoin. People still don't understand that, but that is why people are moving towards Bitcoin. So what does this report say for valuations? Let's go down all the way. You can read all of this really interesting information. VanEck, too, is one of the companies that released the cryptocurrency ETFs in the U.S. Bitcoin scenario by 2050. This is the base price, bear price, so worst case scenario, and then bullish scenario. And this is the bullish one is if it happened, great, but would take a lot for that to happen. But base scenario, 2.9 million US dollars per Bitcoin, and there's a lot of math that goes behind this. That's with a Bitcoin share of domestic gross domestic product of just 5%. So they're saying, and it would be realistic for the price to be just a hair under $3 million per Bitcoin in 2050. Is that going to happen? Who the hell knows? Hopefully we're around to find out. Maybe we can come back to this stream and look at this number. Bear case scenario, 130,314. I think that's extremely low, but that's their worst case scenario. And then their best case scenario, which I think is ridiculous, 52.3 million US dollars. That would be governments taking it into treasury and finally storing their value of their money in Bitcoin and Bitcoin having a 10% share of gross domestic product and a 20% share of international trade. I just think that's highly realistic. I think 10% possibly, though probably 7, 8, but 52.3 million US dollars is their best case scenario prediction from VanEck. Hey, I hope it does. There'll be a lot of life-changing money out there for people that took the risk and thought, yep, this could be the way of the future for storing value. We'll see. But go check it out. It's an interesting read. Sometimes I just find interesting stuff on the web. This is a cool tweet. This says that people don't understand how big Africa is. I never understood either, but they took all the different countries of the world. Not all of them, but most of them, even some of the biggest like the US, China, and India, and put it geographically into this map of Africa. And it shows you the African continent fits not only China, India, the US, Japan, but also the UK and a lot of these European countries too. So it is true, Africa is a huge country. So there you go. See, we got anything. I think that's going to be it. We've gone through a lot today. My mouth is dry. I'm tired of talking, even as much as I love talking to you guys. Don't forget to come back next Thursday for Narinda from Cufflink Live here, 7:30 p.m. All being well, should the peer-to-peer gods be in our favor, please hit that thumbs up if you can. I'm going to get out of here. Let's see if you have any interesting comments. Dave Dawson said you would pick Cufflink out of the alternative credit investor list as they have a secondary market. Annabelle says 8 assets capital charge now if you withdraw more than once per quarter. That's off for your cash account. Yes, true. George says, go to the very bottom of the web page, left-hand side where it details about us, and there is a peer-to-peer login. Is that true? Let me look at that, because I searched around. I got quite frustrated about not being able to find the login. It'd be nice if they told people that. Yeah, there it is right down there. He's right. Thank you, George. It's right down here at the bottom. I didn't spot it. That's why I have you guys. You spot things I don't. Don't you just love how Stuart Law makes it sound like he's doing us all a big favor? I know. Exactly. Hi, Stephen Hale. Nice to see you. Finally, Dave Wilson says, I like Propland. Some of their loans are 3 years. Just do not have too many loans popping up currently. It's kind of some of the things they're talking about, people's frustrations with cash drag. Yep, you're right. Anyway, thanks for joining. Appreciate even every single one of you. We'll see you next Thursday. That's all I got for you. Hope you have a wonderful weekend. I'll see you next time. Take care. Bye.